Welcome to Global Insights with me, Puneeta Kumar Sinha. Today we analyze the frontier markets, or what many call the fourth world. These are countries like Vietnam, Kuwait, Nigeria, and other African and Middle Eastern countries. The view is that the frontier markets will outperform BRICS and other developed countries. But these markets have their own share of risks, like politics, volatility, corruption, weak corporate governance, and illiquidity. So why the charm of investing in frontier markets? Lawrence Speidel of Frontier Markets Asset Management and Andrew Brundle of HSBC's Frontier Markets Fund join us today to discuss that and more. But first, let's take a look at why the frontier markets are emerging as a significant part of the global economy. Nikhil Shivadas has this report.
The world economy is in a tizzy. Large markets of the developed world like the USA and the Eurozone are struggling to keep growth on track. That has had a cascading impact on several high-growth economies like the BRIC Group, which has extensive linkages with developed nations. But some investors are spotting opportunities in several pre-emerging markets or frontier markets.
There's a lot of other interesting places doing interesting things. Nigeria is one that stands out to me. I think Turkey continues to be very exciting. Mexico, in an odd way, is a big winner from China going up the higher wages curve. So I think there's lots of opportunities around the emerging world.
There are 25 such emerging economies in the MSCI Frontier Market Index. And Kuwait, Qatar, Nigeria, UAE and Pakistan are the heavyweights. According to HSBC's GIF Frontier Market Fund report, in July this year, the MSCI Frontier Emerging Markets Capped Index, which limits each country's weight to a maximum of 15%, posted a month-on-month return of 1.8%, outperforming the MSCI Global Emerging Markets Index, which returned 1.6%, and the MSCI World Index, which did 1.2%. But these returns come with high risks.
In all frontier markets, the main risks arise from the fact that you have settlement systems that are not necessarily adequate. There is political uncertainty and potentially a great deal of additional volatility given that trading volumes are thin and liquidity is somewhat challenging.
I think the case for frontier markets is really a very, very long-term one, and I don't think it provides an adequate hedge against any implosion from Eurozone or any other financial contagion.
So the risks are high, but so are the returns. Frontier markets are currently trading at a price-to-book value of about 1.3 versus emerging markets which are currently at 1.6. With several emerging markets including India losing their sheen, frontier markets seem like the best option for most global fund managers in the current times.
Joining me today is Lawrence Speidel, founding partner and chief investment officer of Frontier Market Asset Management. Lawrence, or Larry as he's popularly known, has 40 years of developed and emerging markets experience. Prior to founding Frontier Asset Management, he was partner and director at Nicholas Applegate. Larry, you've been investing for several decades in developed and emerging markets, but over the last few years, you have focused primarily on frontier markets. Tell us why you prefer to invest in the frontier markets.
Just as was the case investing in emerging markets 20 years ago, there's a huge opportunity today to go beyond the popular emerging markets, or in particular the popular BRIC markets, and look at those places that are beyond the universe of the MSCI Emerging Markets Index. And there are approximately 60 countries with stock markets in the frontier. And we invest in 25 of them, and it's just like the good old days in emerging markets.
Larry, what is your definition of a frontier market, and how are they different from the smaller emerging markets like Thailand, Turkey, or Indonesia?
Very simply, any country that's not included in the MSCI Emerging Markets Index. And the MSCI Emerging Markets Index is founded upon certain liquidity requirements in terms of stock-by-stock liquidity and overall market liquidity, as well as certain criteria for the settlement of trades. So beyond that, there are countries which are of equal quality equal rankings of economic freedom by the Heritage Foundation, for example, yet they are small. They have relatively few stocks, they don't have large capitalization stocks, and so they're not sufficient to be part of the emerging markets world. Therein lies this opportunity.
Now, many people are calling the frontier markets the fourth world. Do you agree?
I actually prefer the term developing for a concept that embraces both emerging and frontier, that does not discriminate between third and fourth or first and second. Because I mentioned early on, when you look at the Heritage Foundation ranks of economic freedom, you find that often in those rankings, the BRICS, India, China, and Russia, fall below the rest of emerging markets and frontier markets in terms of measures of economic freedom. And those measures include things like corruption from Transparency International, ease of doing business from the World Bank, measures of property rights. And so, you know, I think that sometimes our broad brush generalizations fail us.
What themes make you want to invest in these markets versus investing in emerging markets like Turkey or Indonesia?
The fundamental notion is that there is a rising middle class. And you've seen it in India. It's happening everywhere. And it's happening on the back of simple things like the introduction of cell phones, mobile phones. And in Africa, for example, people are now using applications on their mobile phones to move money around, to send money from the cities to relatives in the countryside. They're buying insurance on the mobile phones. They're getting crop reports on the mobile phones. But then in addition to that, there are better economic policies. Just as you've seen a transformation in India in terms of some of the economic policies moving away from socialism, you see that happening in sub-Saharan Africa as well. And you see better politics. You see more free elections. You see fewer of the old big men autocratic rulers. And so there are lots of things happening that are feeding into this rise of a middle class that has at last broken out of the poverty trap.
Larry, we're going to take a short break now, but once we return, we're going to talk to you about the kind of returns investors can get from these markets. So stay tuned.
Markets.
Welcome back. You're watching Global Insights with me, Punita Kumar Sinha, and I'm in conversation with Larry Speidel of Frontier Markets Asset Management. Larry, people talk about low correlations in new frontier markets. Is investing there a case for diversification or absolute returns or both? What kind of returns do you think investors can expect from these markets?
The data we use from MSCI ex-GCC, so this is excluding the rich oil producers, the PE on a trailing 12 months basis of the frontier is at a discount to emerging markets of 32%. And it's at a discount to the U.S. market of about 45%. So I think those discounts are huge. And I think that those discounts are not justified by the fundamentals.
To continue on your discussion on valuations, I agree these frontier markets trade at a significant discount to emerging markets. In fact, many companies like Nestle, Unilever trade between 8 to 12 PE, which is really low compared to what these stocks trade in India. I noticed that you have about 70% of your portfolios in consumer staples and financials. And you seem to have a view that the financial sector is in much better shape in frontier markets than in emerging markets. Why is that?
We favor consumer staple companies, the Unilevers that you've mentioned, and we also favor the banks. And the reason for that is that banks in the frontier are making money the old-fashioned way. They're not buying derivative securities and puts and calls and collateralized debt obligations and things like that. They're simply taking in deposits and making loans to customers. And even with respect to that, their loans to customers have traditionally been to the government or to large corporations, and only now are they beginning to be aware of the huge opportunity to make loans to the very same people who are their own depositors, to the retail clients. And these banks in the frontier are enjoying the luxury of net interest margins of 5% to as much as 15%. While in the developed world, you're lucky to see net interest margins of 1–1.5%. So therefore, these banks in the frontier do not need to leverage their capital 40 times or 20 times. You know, they can have low leverage, they can have low loan-to-deposit ratios. They are sitting on top of a huge opportunity, we believe.
The infrastructure sector has done well in the past in the early years of other emerging markets. Do you like the infrastructure sector?
Yeah, I think infrastructure is crucial to these countries. It's just investing is challenging. A great deal of infrastructure investing is being done today by China and India in the frontier, in the context of building roads, of financing the rebuilding of railroads. And that's crucial to improving efficiency and improving productivity in these places. But then you look at the flip side of that, and when you have investment opportunities in the power sector that may not be funded by India and China, then you need to look at the requirements of capital and the challenges of raising capital in a capital-scarce world. And so that's why some that may not be funded by India and China, then you need to look at the requirements of capital and the challenges of raising capital in a capital-scarce world. And so that's why we're sometimes skeptical about the ability of infrastructure companies to fulfill on their promise in terms of their abilities to generate the capital needed to invest and then ultimately to produce the return back to shareholders.
So what are the risks of investing in frontier markets, and how do you mitigate those?
Our approach is to diversify. This is why we invest in 25 stock markets. We monitor liquidity carefully, and we don't want to be more than 5% of the float of any individual company, and we don't want to have more than 10 to 12% invested in any one country.
What are your favorite markets right now?
Well, favorite markets are hard to pick. You know, it's one of those things where I could simply say we do love sub-Saharan Africa and invest in a dozen countries there. We have a number of investments in Ghana, which is small and illiquid, but a very exciting place. The country recently discovered oil for the first time, and GDP growth has been double digits. It's going to be close to 10% this year. We like Romania in Eastern Europe. It has some political problems, but the valuations are compelling. We like some companies in Central America. Vietnam we're looking carefully at, but it's a confusing place with a lot of conglomerate companies that are badly managed. So I guess what's my favorite place? Well, in another month I'm headed to Mozambique and Zimbabwe. And I would say that Zimbabwe is at a crux in history. There's an election going to come up. I think it'll be better than the past. The companies there are generally neglected globally, and yet they're well run.
Larry, thank you very much for joining us.
Thank you.
We are headed for a short break now. Andrew Brundle of HSBC's Frontier Markets Fund will join us in just a bit, so stay tuned. Welcome back. You're watching Global Insights with me, Punita Kumar Sinha. And today we are focusing on the new frontier markets. And Andrew Brundle, Senior Portfolio Manager with HSBC's Frontier Markets Fund, is with me today to give his outlook. Andrew has over a decade of experience in the fund management industry. Andrew, thank you very much for joining us today. Andrew, what are your favorite markets amongst the frontier markets?
Sure. We have a number. We're very encouraged by what we see in Nigeria. for example, a number of changes going on there, a lot of growing companies on cheap valuations. We see good opportunities in the Middle East, whether it's in the UAE, for example, a country like that, and an emirate like Dubai, for example. Perhaps expectations are quite low, but we actually see good improvements happening there, and some good economic activity picking up there. We see good opportunities in Saudi Arabia in terms of some of the changes and that are going on there, and the opportunities we see within that country as well. We see good opportunities in parts of Europe, like Estonia. We see opportunities in Egypt as well. So there's a whole host of markets that we see good growing companies that are in macroeconomic environments that are changing for the better and are trading on cheap valuations.
So you would invest in these markets more for diversification, or do you think they're also going to offer better returns?
No, we do expect them to do better. Yeah, over the long term, we do expect them to grow a bit more quickly. Given the penetration rates of the banking system and the amount of middle-class consumers, for example, will be smaller in these frontier countries and emerging markets. So this investment is all about relative change, and we would expect there to be more change in banking penetration, in the size of the middle classes, in terms of capital markets regulation, and therefore overall also in terms of GDP growth. And all of the World Bank figures will show you that if you look at what's expected in terms of GDP growth from the sorts of countries we're talking about versus emerging markets. I mean, outside of China and perhaps India, the average GDP growth is expected to be higher, and I would expect the good companies within those countries to grow their profits at a multiple of real GDP, and therefore I would expect those earnings growth figures to be higher on average than we would see from emerging markets.
Andrew, in my experience of investing in Bangladesh and Sri Lanka over the last 20 years, they have actually lagged behind India quite a bit. Why do you think this is going to change over the next 20 years?
Yeah, no, I think that's a good point. And as I touched on, relative change is important here. That's what we're talking about. And I think India has done very, very well. It's done well because perhaps it has a slightly more progressive legal and capital market system than we've seen in Sri Lanka and Bangladesh up until now. That's attracted more foreign investment. It's been easier to access capital markets within India than some of the smaller frontier countries. But that's the definition of a frontier country. That's what we're talking about. It's the very fact that now we're beginning to see changes in those countries. Of course, Sri Lanka has just come out of a number of years of civil war, so it's understandable that it hasn't seen the sort of investment that we've seen in India, and therefore it's understandable as to why it hasn't really returned the same kind of performance that you're talking about that you've seen within India. But that's beginning to change now, and that's what this portfolio is about. It's about not trying to pick the one or two countries that are going to do well. It's about having a diversified portfolio of countries that generally we expect to see a relatively positive change, whether it's coming out of civil war, whether it's really beginning to tackle the banking system like we're seeing in the Bangladeshi central bank working with the IMF to do exactly that, whether it's better skilled workers on an attractive wage structure like we're seeing in Vietnam, similarly in the Philippines. So these countries now are beginning to take up the mantle of perhaps where China and India left off, and China and India beginning to develop in other ways. And now it's countries like Bangladesh, like Sri Lanka, like Vietnam, like the Philippines that bring skilled workers at an attractive wage level that means that they are now of interest to foreigners and will start to invest in them. So yes, there are reasons to our minds why 20 years ago you couldn't have expected to see that, whereas perhaps now you can.
You say that India has developed now, but there's still a large segment of emerging companies in the mid and small cap space in India. Why do you think that the frontier markets offer better opportunities than that space?
There are similarities, of course, in terms of perhaps the amount of information that's available about these companies, whether they're large companies in Nigeria or small companies in India. There will be some similarities there, and perhaps there'll also be some pricing inefficiencies that sophisticated investors could take advantage of, which is something that we do. But there are differences. For example, when you're looking at the smaller capped Indian companies, there's only one central bank, there's one monetary policy, there's one political structure, there's one legal structure. And so, yes, that's slightly more straightforward, but it's one risk, whereas, and therefore one opportunity. Whereas by diversifying across frontier markets, you're getting just as many, if not more, opportunities, but you're also able to diversify that risk. The other important difference, I would say, is that these are small and medium-capped companies within India, say, who have larger competitors above them that it's going to be difficult for them to sort of break away from and sort of take share from. Whereas we're investing in the large, dominant companies within these frontier markets who can go on to really begin to shape the industry within which they're working. And, as we know, a stock market is basically the survival of the fittest. Those big companies that do well, that are well managed, that generate strong cash returns, will begin to take market share in a market that's growing within their country and really begin to create great opportunities for investors who get in at this early stage. It's going to be slightly harder for the smaller and mid-cap companies within China and India who are already competing in sectors that are already reasonably developed, and they have much bigger competitors already above them.
Andrew, thank you very much for sharing your views with us. So there's lots of opportunity, but requires a lot of hard work to find the stocks, and one has to take a long-term view. Now let's see what the other analysts and experts are saying about the frontier markets. Tanveer Gill joins us to share this data. Tanveer, what does the data show?
Well, Puneeta, as you've been discussing, these are under-researched markets, so I thought let's give our viewers some analysis on how these markets have done historically and what the future holds for them. So I compared the MSCI Emerging Market Index with the MSCI Frontier Market Index, and, the trend line which will come up on your screens will reflect the fact that over a 5-year period, EM index has done much better and has been a ranked outperformer to the MSCI Frontier Market Index. Even on an annualized basis, from 2008 to 2011, the performance has been better. The dividend yield, interestingly, for the Frontier Market Index has been higher at about 4.9 versus about 3% for the Emerging Market Index. However, given the risk-adjusted returns being higher for the Emerging Market Index, you're looking at a price-to-earnings premium coming in there. So on a forward earnings multiple, the estimate is, 10.5, 11 times for the Emerging Market Index, whereas for the Frontier Market Index is about 9.5 to 10 times. And that brings me to my question to you, Puneeta. How real is the opportunity in frontier markets at this point?
So Tanveer, in this slow growth environment globally, everyone's looking for growth. So to the extent that the frontier markets offer tremendous growth opportunities, I think they're going to attract investor interest. But you have to keep in mind that, the market cap of some of these economies and markets is very low compared to the emerging markets. Frontier markets as a whole, the market cap is only 5% of the total market cap of the MSCI emerging markets. And if you look at, individual countries, let's take the example of, say, Bangladesh. Bangladesh's market cap is only 20 billion. If you compare that to India, which is, over $1 trillion. So even if you find a lot of opportunities, the challenge really is how do you put lots of money to work? Yeah. You can't put a lot of money to work. And if you do, you have to really be careful about exit. Because, if you sell, you can actually drive down those stocks. So you have to take a long-term view.
I think it's more about managing risks there than managing returns?
Yes, I think absolutely. I think you can get a lot of return, but you have to be able to manage the risks.
Okay. For India, as an economy, as a market, what do we derive from the potential or the opportunity that frontier markets have right now?
If you look at the number of ways in India, in which India can benefit, first of all, India can benefit from the consumption theme and the growing domestic consumer base in these countries. And we've seen, Indian companies already establish presence in, say, Africa. For instance, we've seen Dabur, Godrej Consumer, we've seen a lot of the auto companies, we've seen the pharmaceutical companies, and of course, a lot of telecom companies are looking for opportunities in Africa as well. So Indian companies are already there. The second way in which Indian companies can benefit is by, exploiting the low-cost manufacturing sector in some of these countries. Say, for instance, Bangladesh, in textiles is very low cost compared to India, so you can benefit from that. The third way in which I think Indian companies are benefiting are that they are actually going out to some of these countries and buying natural resources. Yeah. We've seen a number of Indian companies go to Africa and buy coal mines, oil blocks, and I think that will help the Indian companies. And I think if you look at India, the trade in some of these with some of these countries is still quite low. So India has a lot of opportunity to expand its exports and increase trade linkages. India's trade with Africa is estimated only at about $40 billion. And then if you look at countries like Sri Lanka, India's exports are accounting for almost about 15% of Sri Lanka's imports.
Wow.
So India can actually improve its current account deficit if it starts, improving trade with some of these countries, in my view. With that, it's a wrap on this edition of Global Insights. Do join us next week as we discuss Japan and the lessons to be learned from its economic model. Thank you very much for watching.